Okay, well, hello everybody. Today we are going to talk about break-even analysis, and I'm going to bring up my video for a second. Hello, I'm freezing today, so I don't know why I'm so cold, but I am. But I got my, Steelers sweatshirt on. Go Steelers, they're 2-0. Anyways, we're going to talk about break-even today. A couple other topics that are associated with break-even. We're going to look at variable costs versus fixed costs, and then we'll also get into leverage, and in particular, the degree of operating leverage. So those are the topics on the agenda. From a textbook point of view, it's basically Chapter 5 and Chapter 5A. So they're kind of like, I'm not sure why they made it an appendix. It's only like 3 pages long or something like that. But those are that's the material we're going to cover. So I'm going to get off this video so you're not distracted by all this black and gold and beard and hat. I'm freezing. All right, so let's get me out of there. There you go. Much more shaven looking version of me. But hopefully you can see that. I know last time I did this and there was just like a silhouette of a picture or of a, I don't know, like a stick figure or something like that. So hopefully you can see it this time. But it was kind of fun. When I saw it the last time, I'm like, oh my God, what the heck? But I want to bring up my Excel spreadsheet, so bear with me. It should be coming up anytime soon. It says it's connecting. And I think we are sharing. Yes, it says currently sharing. All right. So as you can see there, I have a couple of different definitions for variable cost and fixed costs. So variable cost, a cost that changes as activity levels change. So when we're talking about, units, or in the medical field, number of visits, that's what we mean about activity levels. So the more people that come into the office, the more money in theory the office makes, but you got to take costs into account along with revenues into account. So, but we're talking costs right now. Okay, so costs that change as activity levels change. So your RG&E bill, or if you're not from the Rochester area, your gas and electric, sales commissions, if you're paying your employees a percentage of what they sell, the more they sell, the more you got to pay them. So that's why sales commissions would be considered a variable cost. Royalties as well, and direct labor would be considered, a variable cost, because depending on how many hours the employee works, that can affect the amount of money you pay them. I also have here depreciation, and I also have depreciation down here. So depending on the type of depreciation method you are using, it could determine whether or not it's a variable cost or a fixed cost. So if you're using the units of production method, units of production, which obviously you can see there I have as UP. Just don't pee right now because we're in the middle of a session. Told you I got bad jokes. So units of production, I've also known this to be called units of activity. But if the company is using this technique, the depreciation method would cause the depreciation amount to vary from period to period. Okay? And when you write up your summary for me, make sure you mention if that was a good joke or a bad joke. All right, just checking, just making sure you're paying attention. All right, fixed costs. These are costs that do not vary with volume of activity, at least within a relevant range. So property taxes, you might say, well, I thought my taxes go up every year. Well, within that 1 year time frame, they're fixed, and they have nothing to do with, activity. It doesn't matter if you've got one person in your house or 3 people in your house, your tax is the same. Somebody's salary is pretty much a fixed costs. Rent, insurance, those are fixed costs. They have nothing to do with activity. And then as you can see here, another depreciation method, straight line, double declining balance, and even some of the year's digits, if some of you know that fourth and final depreciation technique. So these techniques are not related to activity, therefore, they're considered to be fixed costs. So in previous videos, we've talked financial statements. And again, just a quick little summary. Your income statement could look as simple as this: revenue minus expenses, and that equals net income. It could get a little bit more exciting by going sales minus cost of goods sold equals gross profit minus your operating expenses. That gives you basically your operating income, or your earnings before interest and taxes. Then subtract out your interest expense, gives you your earnings before taxes. I think we need an equal sign there, not a minus sign. And then we take out our tax expense, and that gives us our earnings after taxes. So that's another way that you can do your income statement. Now, it's not like you can say, oh, let me do it this way, let me do it that way, because it doesn't matter. It does matter. It depends on the type of industry you're in. So if you're in a service business, you're going to be using basically this income statement. Very simplistic, but it's service oriented. If you're using an income statement that is, or excuse me, if you're in an industry where you're selling product, then you would use this style. These are both external versions of an income statement. External, meaning that anybody outside the company would be privy to, okay, if they wanted to see them. However, there is an internal version of an income statement, and this internal version, I don't know why the font is so weird. Kind of strange. Hang on a second. Let's see if I can fix that a little bit here. Well, a little bit better. So an internal version of an income statement could look like this. You have your sales, but instead of separating the expenses like we just did in the previous two, where in the first one all the expenses are grouped into one category. In the second one, I've got cost of goods sold, which is an expense, operating expense, obviously an expense, interest expense, tax expense. I'm separating all of it out, okay? However, I could do it this way, right? And it would be for me to subtract out my variable costs, which is just another way of saying variable expenses. And when I do that subtraction, it gives me contribution margin. So basically, if someone said, hey, what's the definition of contribution margin? It's sales minus variable cost. And then we would subtract out our fixed costs. Again, the word cost is another way of saying expense. And this would give you your net income. And this is before your taxes. So this is like, EBT. Same thing with this one. All right. So I just wanted to make sure you saw this yet another version of an income statement, but the difference is this one is used for internal purposes. So for managerial type of accounting, so you still get the same result, when it's all said and done. but the difference is that it's separated out into different categories. And it's this style of income statement that sometimes is used when it comes to break-even analysis, which is a managerial type of thing. Okay? So speaking of that, let's jump to this other slide that I have here ready to go. And when it's time to do break-even analysis, I know of two styles. I don't know if other styles exist, but these are the two that I know about. One is the equation method. And if you look very carefully at this equation method, it kind of looks like that internal income statement I was just showing you, just on its side, kind of. I mean, look at, sales minus variable, selling price minus variable cost per unit. So selling price per unit, which is kind of like sales, variable cost per unit, which is like the variable cost. I don't see the contribution margin on that row, but that's what SP minus VC means. So SP is let me just write that over here. SP is short for selling price, and VC is short for variable cost, and FC is short for fixed costs. Okay, so when you want to calculate break even, so let's just talk in general now about break even. When you're running a business, whether it's in the medical field or non-medical field, you're trying to figure out what do you have to do to break even, so that like for example, let's say I do a break-even analysis for a shoe store, and I find out that I need to sell 30 pairs of shoes in order to break even. Anything below 30 pairs of shoes, I'm losing money. Anything above 30 pairs of shoes, I'm going to be making a profit. So it helps companies kind of set a goal as to what they need to do in order to be profitable. That's why when companies are doing their monthly and quarterly and annual reports, and that's how they kind of know if we're going to have a bad quarter or we're going to have a really good quarter, because they know their break even. They know what they have to hit, what kind of targets to hit in order to be successful. Okay, so one of the things you want to do first is let's just calculate basic break even. So let's use this data right here. Let me give it a different color here to make it stand out. So I said, what if we pretend the selling price is $5 per unit? So whatever item we're talking about, let's say it's a plate, plate that you eat off of, and we're going to sell it for $5, but it costs us $2 to make the plate. And fixed costs, remember we were just defining variable and fixed, your property taxes, your controller salary, your rent, your insurance, all that kind of stuff, all right? We're going to pretend our fixed costs are $600. So if I go through and put that into my formula, it would read something like this. We got $5 X. I'm going to use like algebra. Hope that doesn't scare too many people. Nothing fancy though. 5X minus $2 X minus your $600. That's not X, because remember, fixed cost has nothing to do with activity. Only the selling price and the variable costs vary with level of activity. Okay. So like if you decided to open up a little hot dog stand in your neighborhood, well, let's say not in your neighborhood. Well, yeah, let's say you want to rent a space in the local strip mall, right? You're going to pay X amount of dollars per month for rent. But let's say you got to buy hot dogs, you got to buy the buns, the condiments, all that kind of stuff. So as it turns out, you're going to sell a hot dog for $5. It'd be one heck of a hot dog, but it's going to cost you $2 to make it. So in essence, you're having a contribution margin of $3 contributing to your bottom line. So you'll see I have here CM per unit. The definition of CM is right here. So let me put that in the same color blue. So if someone said to you, hey, how do you calculate contribution margin? You would simply go selling price minus variable cost. And if you remember from the previous sheet, here it is. Sales minus variable cost gives you contribution margin. So you can calculate contribution margin in dollars. You can also calculate it from a per unit point of view. Right? So you have the option of going, either direction. Okay? But we're going in dollars right now. So 5x minus 2x minus 600, and we're going to set it equal to 0. So in essence, we want to basically figure out how many units do we need to make, or sell in this case, in order to break even. So if we do the contribution margin, 5x minus 2x, 5x minus 2x, that gives us 3x, $3x. And if we subtract our $600 worth of fixed costs, so I'm just cleaning up our math. If you remember from your math classes when you were a kid, or even as an adult, you may have to take some math classes when you're doing algebra, combine your like terms. So 5x minus 2x gives me 3x. So that's all I'm doing in that first one. Just spreading this out a tad. Okay, so now 3x minus 600 equals 0. Let's continue to combine like terms. I'm going to add 600 to both sides. Because remember, in algebra, the goal is to get the x's on one side and the numbers on the other side. So if I do that math, I'm adding 600 to both sides. I end up with 3x on one side and on the other side I have 600. So basically showing you all the algebraic steps. I could have done this in 1 second in my head, but just want to make sure you understand. Then we want to divide both sides by 3. Divide by what's in front of, I don't want that. We want to divide by what is in front of the letter, the variable. Gotta clean this up for a second, hang on. Okay, so divide this side by 3, and then divide the other side by 3. And when you do that, you end up with x equals 200. Now, let me just put a $sign in front of these 3's, because when you divide a dollar by a dollar, the dollar signs technically cancel each other out, and you're left with units. So by doing this algebra, I was able to discover the answer of I need to sell 200 units of whatever thing, this plate, this imaginary item that we were talking about, in order to break even. We need to see 200 patients, in order to break even, whatever the scenario happens to be. So this is one way that you can calculate break even, and this is the way I loved doing it because I was a huge algebra fan. I don't know why, I just was. But I also liked it because I always thought I had a pretty crappy memory as a student. And I already knew how to do an income statement, and this just reminded me of an income statement on its side, but it was just set to 0. So for me, it was like, hey, I got enough stuff in my head to remember. This is just going to make it simpler because it's very similar to something I already know. However, There is an alternative way, which basically there's like a set formula that you could use, and that's over here in green. All right, let me put the title in green as well. And what that's all about is the fact that, there we go, that I don't have to do any of the algebra. It'll take me right to this last step, which I'm going to highlight in green here just so I can prove it to you. So the formula is fixed costs divided by contribution margin per unit. So we know when I went through all of the algebra, I basically ended up with this final approach. So if I take my fixed costs, again, I'm just following the formula. The fixed cost is $600, looking at the data. And I divide it by my contribution margin per unit. So 5 minus 2, that's 3. $600 divided by 3 gives me 200 units to break even. So it's obviously a lot easier to do that. If, I mean, for us, if you don't have to memorize for an exam, then it doesn't matter which way you do it, but if you had to memorize a whole bunch of stuff, I don't know, maybe the equation method might be easier for you, like it was for me back in the day, but you have two different ways to come up with the answer. All right, you pick the one that you're more comfortable with. Okay. Now, whether you are using the equation method or the contribution margin method, once you have your units to break even, you can also figure out your break even in sales dollars. So to calculate your break even in sales dollars, all you got to do is take your break even in units and multiply it by your selling price. And the result is $1,000. So remember before when I was saying, hey, I got to figure out how many pairs of shoes I need in order to break even? Well, and we said, oh, we need 200 pairs of shoes to break even. Well, what if, hang on a second, I got some technical difficulties going on right here. We'll just put it here. A lot easier than to fight with it. So when people are, figuring out things, sometimes people like to talk in units, some people like to talk in money. So if I said to you, hey, we need to sell 200 pairs of shoes to break even, other people might like to look at it as, hey, we need to have $1,000 in revenue, $1,000 in sales to break even. So whether your cup of tea is in unit jargon or in dollars jargon, you should be able to figure out break even in units and also be able to calculate it in sales dollars. Okay? So what about this scenario that I have here? I got another little data box. And in this data box, I'm giving you sales, $650, fixed costs, $330, variable costs, $390, and number of units sold, 130. So if you want, why don't you pause the recording for a second and see if you can't figure out, what the break even is in units and what it is in sales dollars. And then come back in a couple of minutes and then we'll go over it. Okay? Okay, so if you worked on that, the first thing you had to do was to get it in this lingo. The selling price per unit and the variable cost per unit. That should have been the approach, because without that you may have struggled. So what we should do is take the sales of $650 and divide it by the 130 units. And if you did that, 650 divided by 130, you get $5 per unit. So there's your selling price per unit. Okay. And then you would have had to do the same thing with the variable costs. You would have taken this, the $390, divided that by the 130 units, and that would give you $5, or excuse me, $3 per unit. Okay, so why don't you turn off the recording for a second, or pause it I should say, and now go and recalculate your break even now that you have this new information. Okay, if you are back with me now, what you want to do is basically go through whichever technique you like, equation method or contribution margin method. So I'll do the equation method, so 5x minus 3x minus 330, and that's going to equal 0. Remember, if we're calculating break even, you got to set it to 0. 5x minus 3x is 2x, minus 330 equals 0. Add 330 to both sides, we get 2x equals 330. Divide both sides by 2, and what is that, 165? Okay. And that's to break even. If you went one step further and figured out what would it be in sales dollars, take the 165 units and multiply it by $5 per unit. And let me just get it on the calculator, 165 times 5, and that'll give you $825 in sales. That's the amount of sales you need to break even, 825. All right, so let's put that to the test. If I do 825 here, okay, my variable cost, 165 units. Again, if these are the units that I'm doing for break even, I now need to take that 165 and let's multiply that by the $3. That comes out to $495. Bringing me down to a contribution of 330. And now let me subtract out my fixed costs. And voila, look at my net income, 0. So whatever my units were to break even, in this case 165, your selling price and your variable costs are impacted by those units. Your fixed costs have nothing to do with it. What did we have originally with the data? Let's see what was going on there. We had 650 in sales, and you can tell we're already going to have a loss, right? Because we needed at least $825 in sales to make a profit. So they're already, in trouble. Variable costs, 390. Bringing the contribution margin down to 260. And the fixed costs unaffected by activity. You can see in the original data, they had a loss of $70. I'll actually write an L here and put that in red. Dun, dun, dun. Okay, so from the original data, the company was experiencing a loss. So if someone were looking at this and say, hey, what do we got to do to turn this around? How many units do we need to sell to break even? We need to sell 165 units, not 130. So that was the problem. They were only selling 130 units. They need to sell 165 in order to break even. Okay. Another usage of break even would be to, what if you don't want to just do break even? What if you have a target net income? Okay, so I've got some other data for you. So we've got selling price, $24 a unit, variable cost, $16 a unit, fixed costs, $48,000, and target net income after tax, $14,400. And assuming a tax rate of 40%. All right, so we're trying to get a target net income. You can do this before or after tax, but I'm going target net income after tax. Okay, so this is a little bit more challenging because now you've got to do a little bit of finagling on the right-hand side of the equation compared to what we were doing before. So if we were to just do break even, let's just start there. All right, let's keep it simple. Let's just do break even with the stuff that's to the left. So if I said, go ahead, calculate break even, you've got selling price, variable costs, and fixed costs. Why don't you pause the recording and go calculate that real quick. Okay, so if you're back, hopefully you are, or else you wouldn't be hearing me right now. 24x minus 16x minus 48,000 equals 0. Now I know this wasn't the question, but we're going ahead and just practicing our break even. So 24x minus 16x is going to give us 8x. So add 48,000 to both sides. So subtract 48 from the left, add it to the right. So now we're looking at 8x equals 48,000. Let's do that math. 48, I need to stretch this. Hate when that happens. So 48,000 divided by 8. That'll give us 6,000 units to break even. And what would be the answer in break even in sales dollars? If you said, hey, you got to take 6,000 and multiply it by the $24 selling price, you are right. So let me do that math real quick. 6,000 multiplied by 24, 144,000. In order to break even. So we know our break even point is 6,000 units, and we would have to have sales of $144,000 to hit that break even. But what if we wanted to hit a target? So we know we need 6,000 units to get to 0, but what would be how many units we would need to have a target net income after tax of $14,400. Okay, so before you can do that, before you can do the target net income before tax, we need to figure out what would be our target net income. Let me rephrase that. In order to get our net income after tax, I would need to know what my target net income before tax is. Okay? And it's a little challenging, but I have the formula right here. So to calculate your target net income before tax, you first have to take that target net income after tax and divide it by 1 minus the tax rate. So kind of tricky. So if we want to take that $14,400 and we want to divide it by 1 minus the tax rate. And now the tax rate that I have is totally outlandish these days because we know the corporate tax rate is 21% since the 2018 tax law changes, and it's a flat rate. I think I mentioned that in one of my earlier videos, but I'm just pretending it's 40% here. So we would take whatever the target net income after taxes and divide it basically by 60%, 1 minus the tax rate. So if you go 14.4 and divide it by 60%, that's 1 minus the tax rate. It looks like I lost part of my numbers again. There it is. So let's do that math. So 14.4 divided by 0.60, that gives me $24,000. That would be your target net income before tax. So in order to get our target net income before tax, I had to first figure out my net income after tax, because that's what they gave me in the question. If they had given me, hey, calculate the target net income before tax, I wouldn't have had to do any of this. I would have just stuck the 24,000 right in place of the 0. All right. So instead of hitting 0 as the target, we're trying to hit a target of some other number. So if we were doing before tax, then I would have taken the 24 that they would have given me and just put that instead of the 0. But they said they're only giving us target net income after tax. So I had to convert the after tax result into a before tax result. So just to put that in perspective, I'm not sure if you believe me or not. Let's test it out. So if we had sales, right, and we want to calculate our sales, how much would that be? What, 24 times? Well, let's hang on. Let's hang on to that for a second. I'll go and prove it later. Let's actually follow through with what we've already done now. So let's actually calculate our target and figure out how many units we've got to come up with to hit the target. We know that to break even we need 6,000, and that's a hit 0. Now we're trying to hit 24,000 before tax, 14.4 after tax. Right? So our selling price per unit is $24. And we want to subtract out our $16 per unit for variable costs. And then we're going to subtract out our fixed costs of $48,000. And we're going to set this equal. If it was break even, it would be 0. But because we're going target after tax, I still can't use the 14.4. I had to figure out what it was before tax. I had to take the 14.4 and divide it by 1 minus the tax rate. So if I was using 2020, it'd be 1 minus 21%, which would be 14.4 divided by 79%. Okay. But anyways, so let's put 24,000 in the spot. And now let's go ahead and finish the math. 24 minus 16, that's 8x. Minus the 48,000. Again, going slow here. You might be able to skip some steps if you know what you're doing. Okay. But this would be an example, like if I was given a test and I said, hey, please show your work. You know, if you just put an answer down and it looks nothing like mine, I have no idea where you made your mistake. So if you show your steps, at least I can give you some partial credit if you were taking a test from me. So we continue along here, 8x, and you're going to add 48,000 to both sides. So normally it would be 0 on the right if we were doing break even, but we got 24 in there. So that brings us up to 72,000. And then we're going to divide both sides by 8. And when you do that, you would need 9,000 not to break even, to hit the target that you were aiming for. 9,000 units to hit the target. So let's see if this really is true. Because you don't always want to believe everything you hear, right? So let's say we got sales. And we know the sales would be, if I go with the 24 selling price times the 9,000, that gives us 216. 24 times 9,000. And then the variable costs would be $16 a unit multiplied by 9,000. It gives me 144,000. Let's put some commas into this. There we go. So just doing like a little mini income statement again, but that internal version. This would then give us a contribution margin of 72,000. Then we want to subtract out our fixed costs. So if you're like, hey, it's not going to work because it's not going to equal 0. We're not trying to hit 0. We're not doing break even. We're trying to hit the target, don't forget. So we're going to subtract 48,000. We'll put some math lines in here. So the result of doing this subtraction would be our net income before tax, or EBT, earnings before, shouldn't put it there. So 72, subtract out the 48. So look at that, earnings before tax, 24,000. Remember that 24 we calculated? So now if we take out our tax expense, at 40%. So we would take 24,000 times 40%. So let's do that. 24,000 multiplied by 0.40, that gives me 9,600. Where'd I go here? Oh, I turned off numlock by accident. See, don't ever do that. There we go. And result. Drum roll, please. 14.4. There's your target net income after tax. So in order to get to where we had to do, I had to do some little algebra and knowing how to divide by 1 minus the tax rate in order to get it. So there's a little check to prove the accuracy of this stuff. Okay, so what else can you do with this? Well, in a lot of books that teach break even, usually it's followed up by the topic of leverage, right? And let me just quickly talk about leverage here before I show you some formulas. So I like what your book says about leverage. I'm just going to, I don't know if all books do this, but the one book I'm looking at here, it says, in physics, leverage implies the use of a lever to raise a heavy object with a small amount of force. That's what leverage means in physics. In politics, individuals who have leverage can accomplish much with the smallest word or action, aka money, right? In finance, high operating leverage means that a relatively small change in volume results in a large change in profit. So let me write that one down because this is the one that applies to us. In finance, high operating leverage means that a relatively small change in volume. Remember volume? Those are like units. Results in a large change in profit. Now, when I first teach leverage, I like to use this analogy, okay? First off, I want you to pretend that when you hear the word leverage, just think of risk. Leverage means risk. So the more you gamble, the better chance of winning big. The less you gamble, then there's a less chance of winning big. All right, so the more you gamble, you're being risky, so you're highly leveraged. If you don't risk a lot, you're being conservative. All right, so let's say, for example, you and I go to a carnival and I put $10 on number 5 to win, and you put $1 down on number 5 to win. And let's say if number 5 wins, we get paid 10 to 1. Okay? So I put $10 down, you put $1. Let's say number 5 wins. How much did I win? $100. What did you win? $10. So look how much more money I made because I gambled more. But let's say same scenario, I put $10 down, you put $1, and our number doesn't come in. Well, I'm out $10 where you're only out $1. So in that scenario, I'm the one who was more leveraged. I had more to risk than you did. Okay, so that's usually how I like to introduce leverage. And there's different types of leverage. There is the degree of operating leverage, known as the DOL. There's the degree of financial leverage, known as DFL. And then there's a combination of the two, the degree of combined leverage, DCL. So if you think of the balance sheet for a moment, okay, where we've got assets on one side, and then on the right side, we got our liabilities, and we've got our equity. If we think of the balance sheet for a moment, this is also the accounting equation. Assets on one side, liabilities and equity on the other. So I like to think of the operating leverage as more on the asset side of things. So for example, let's say as a medical facility, we were thinking of bringing in some special equipment, and the special equipment would cost us a lot of money. But if I don't buy this special equipment, I would have to hire one or two people to do what the equipment could do, right? So I have to kind of weigh, do I want to invest heavily in assets, or do I want to invest in people? Any idea which one would be more risky? Which is the one that's more leveraged? If you said the equipment, you are right. Because if I buy this equipment and all of a sudden, you know, people are not interested in coming into our facility, I'm stuck with this equipment. So it's like I took a risk, I bought this equipment, now I'm stuck with it. Nobody else wants it because it only does a specialized function for us, let's say. Whereas if I hired people and I didn't have the right clientele, I hate to say it, but it's true, you can always let go of the people. So in that scenario, you are more leveraged for investing in equipment than you are investing in people, believe it or not. When you talk about degree of financial leverage, now we're like on the liability equity side. So let's say that equipment we were going to buy, what if I were to get investors to give us money? So in other words, let's say we issued stock as one option to raise the money. The other option would be, let's just go borrow from the bank. So investing versus somebody investing in us, giving us the money, versus borrowing from the bank. Which one is the more leveraged scenario? If you said borrowing from the bank, you are right. That is the more leverage. That is the more risky proposition because, again, if things go well, then we're making money and I can make my payments to the bank along with the interest payments, no problem at all. But if things went south, guess what? I still got to make my payments to the bank. I still got to pay them interest. So it's more risky to borrow the money because whether your idea succeeds or not, you still got to pay all that money back. Whereas if you had investors, let's say they were stockholders, there's no law that says you have to pay them a dividend. No law at all. So it's the more risky proposition to borrow than to have people invest. Yes, if things go well with people investing, you got to share the wealth with more people. That is true. But if things go poorly, if you were heavy into debt, you still got to pay off that debt no matter what. You just don't have the cash flow coming in. So degree of combined leverage is taking the asset side and the liability versus equity side and kind of merging it into one result. So let me go to this page here. Here are some formulas that could come in handy for you, whether you're taking a test or just trying to figure out leverage or break even. So here's the formula for break even. Fixed costs divided by your contribution margin, which is, as you know, price per unit minus variable cost per unit. And then I've got two different versions of the operating leverage. So you can either go by units if you're given units, or you can go in dollars. Degree of financial leverage, there's only one way to do that one. Earnings before interest and taxes, EBIT. And you're going to divide that by your earnings before interest and taxes minus your interest. And degree of combined leverage, there's a quantity approach and there's a dollar amount approach. So I was looking through the textbook and I noticed they had a pretty interesting example when it came to figuring out leverage. But there's also a math thing that I remember teaching in some of my math classes. If I said, hey, what's the percent change? Let me just explain that real quick and then I'll get into the example that they had in the book. So if you're ever asked to calculate percent change, do you know how to do that? If something went up by 10%, something went down by 20%, can you calculate percent change? So basically what you have to do is you take the amount that the two numbers that you're looking at, calculate the change, and you're going to divide by the base amount. So let's say, for example, you made $50,000 at the beginning of the year. Let's write this as an example. Your salary was $50,000, let's say in 2019. And in 2020, your salary was $53,000. What percent increase did your salary go up? So if I look at the formula that I have, my salary went from 50 to 53, so the change was $3,000. My base was the older of the two values. So what is $3,000 divided by $50,000? And if you did your math right, it would be 6%. So that would be the percent change. So if someone said, hey, you got a 6% raise, if you were making 50, that would bring you up to 53,000. So there's just a quick little example on how percent change works. The reason why I bring that up is that in the appendix of chapter 5, they have an example where they're looking at an income statement, and I kind of want to run through that example real quick. And this, if you happen to have this book, it's on page 198. So if you're, don't have the book, then I'll just kind of copy everything down here. So we got our revenue, and we're going to pretend that our selling price, let's just use SP. Our selling price is $100. Okay, and our volume, and they have number of visits by patients, 69,165. The variable costs is going to be $28.18. And we're going to multiply that by 69,165. And then we'll be able to calculate our contribution margin. And then we have our fixed costs. And let's assume our fixed costs are 4,967,462. And that would give us a profit, net income, whatever you want to call that final answer. Now, in your book, it's showing a negative value of $32 or 32. These answers, I think, are, well, let's just say it's a negative 32. It should be 0. What if you go back and you look at the examples, at some point they rounded their results, and that caused this to be a little bit wacky, but this should have been 0. The break-even point is really 69,165. It may have actually been 69,164 point something. So I just wanted you to know that this number of 69,165 is slightly rounded, which caused this 32 to not be 0. Okay, so let me just do the math here. 100 times 69,165. That's going to give us 6,916,000. $500. So basically, these answers are slightly off due to rounding, for a lack of a better way of saying it. Okay. And then when I go to calculate the variable cost, we get 1,949,070, giving us a contribution margin and according to the book, it's 4,967,430. That number and the fixed costs should have been the same, but we end up with 32. Okay. So that would be the break-even point. But what if the estimated value is supposed to be 75,000 visits? Okay. So let me just copy this down here. And I'm going to substitute 75,000 for where the 69,165 was. What the heck? Okay, so if I do that math, I get 7,000,005 for the sales. My variable cost would now be 2,113,500. Calculating my new contribution margin, that would be 5,386,500. My fixed costs are going to remain the same at 4,967,462. And then if I do this math, I get 419,038. Let me make those red. But we knew this was going to be a profit because remember I said the 69,165 was the break-even point. So anything above 69,000 is going to create a profit. And sure enough, it did. So if you don't mind, I'm going to take this 32 and I'm just going to make it 0 and just say it's off due to rounding. So they should have done that in the textbook, but they did not. All right. So now what happens if we have a 10% increase in volume? So here's where I want to kind of have you put your thinking caps on here. So here is the formula. Percent change, change divided by base. So if we have a 10%, I mean, you don't actually have to, do anything, just multiply by 10% and then add it. But if I took 7,500,000, I can do this two ways. I could multiply by 10%, get $750,000, add that to the 7,500,000, and I get 8,250,000. Or if I want, I can just use units here, 75,000 units, multiplied by 10%. I get 7,500 units. So 75,000 units plus another 10% would give me 82.5. So let me write this down here. So we'll say 10% increase in patient visits. So if we're expecting a 10% increase, 10% of 75,000 is 7,500. Add 7,500 to 75,000, and that brings us to 82.5. So you can get this 82.5 two different ways. You could go, like I just did, 75,000. Oops, I don't want to be over there. Hang on. So we could go 75,000 times it by 10% gives you 7,500. Then add 7,500 plus the 75,000, and that equals the 82.5. I also know of another way, which is a lot faster. You could take the 75,000 and multiply by 1.10, 110%. And if you do that, you get 82,500 directly. Okay. So let's go back to this percent change thing. What does this have to do with the time of day? What if they never told you about the 10%? What if they just said estimated visits will go up from 75,000 to 82,500? What percent increase is this? So if that's what you were given, you would have gone, okay, what's my change? 82.5 minus 75,000, and I want to divide it by the older of the two amounts, which is the 75,000. Remember, the formula is up here, change divided by base. We went from 75 to 82.5. So do that math, 82.5 minus 75,000, that's 7,500. Divide that by 75,000, and voila, 10%. Okay, just wanted you to know how to do that. Okay, so let's finish the comparison here. So with the number of visits now increased by 10%, the sales are now 8,250,000. The variable cost 2,324,000. And 850. Giving us a contribution margin of 5,925,150. So I'll have the same fixed costs. Remember, your fixed costs are not affected by your activity. So they remain the same no matter what. So now we end up with 957,688 of a profit. Okay. So we had a 10% increase in selling price. What kind of an increase percentage-wise did we have in bottom line? Okay, so if you look at the degree of operating leverage, to get the DOL, as we saw to the left, you're going to take your contribution margin and you're going to divide it by your profit. Except hopefully you can spell profit better than I did. That's what this is. Sales minus total variable cost, that's contribution margin. Sales minus total variable cost minus fixed cost, that's your profit. So if you do that calculation, we're not going to bother with the first one because it would be 0. Anything divided by 0 is 0, as we know. But if we take contribution margin, divide by profit, 5,386,000, and divide by the 419, we get a DOL of 12.8544, which is, in percentage lingo, actually it should be 128.5%. So what this means is that for every 1% change in volume, so for 1% change of volume, 75,000 times 1%, that's 750. For every 1% change, you're going to get a 128.5% change in profit. So it's amazing how that works. Okay, if we were to look at the bottom one with the 82.5, we would get contribution margin and divide that by the profit. In that environment, you've got a 6.19% change. And that's what they were basically trying to explain on page 198. Okay, I think that's what I wanted to cover here. And let me just think if there's anything else. I think that's it. All right, so that'll do it for this video. I would recommend that you do problems 1 through 6 at the end of the chapter. 1 through 6. See if there's anything else, and that should do it. All right. We'll talk to you guys next week. Bye-bye.